Welcome back to the channel. Brad here. Today we're going to talk about core holdings and the difference between SPYI, QQQI, and JEPI and JEPQ. All good funds, but which one is truly my core holding of what I would like a fund to do for me as an income investor? QQQI has a distribution of about 14%. This month's was a little bit higher, but generally it's about 14%. And SPYI is generally right around 12%. They target these percentages in a laddered call options. And we'll talk about that later in the video. When I look at SPYI compared to JEPI, there's definitely more income, greater capital appreciation, less than SPY, and I do believe all of us should hold the S&P 500 and the Qs in our holdings. Might not be a core holding, but some funds, if you can afford it, to be in the two that actually give you full exposure to that index. It's not always have to be about income, but that's just the way that I do it. I generally keep most of my funds in income generating offerings. But clearly, when I look at this chart from NEOS, you can't argue about the percentages. 12% in distributions compared to that 6%. Even when JEPI's good, they're only at 9%. There's definitely a difference in income levels between the two. One benefit of NEOS is they take advantage of Section 1256 contracts on the indexes for tax reasons. You know, it's a 60-40 split on taxes. If you go look at the actual tax documents, it appears that most of it is return of capital, because they also do tax harvesting, selling the stocks that have depreciated so they can actually take the losses, carry those losses, and put those losses off onto us to give us return of capital. That way it becomes a non-taxable event now. You will have to end up paying more taxes later if you sell it, because it will depreciate the actual cost basis of the ETF. So keep that in mind. You may not pay taxes now, but the tax man is going to cometh one day. I looked at total return between the funds, and again, you can see that SPYI compared to JEPI on Seeking Alpha was the clear winner. Dividends on yield on cost, very consistent with SPYI. Moving to Portfolio Visualizer, you can clearly see the winner here. In 2023, JEPI only paid $4,403 compared to $6,648. This is on a $50,000 investment. And when you look at 2024, the clear winner again is NEOS. When we look at total returns, it's keeping up, and this is, again, when I use Portfolio Visualizer, this is including distributions reinvested, so that you get a little bit of different numbers between Seeking Alpha and Portfolio Visualizer, because Seeking Alpha only totals the distributions, where Portfolio Visualizer actually shows you the distributions reinvested. I'm going to go with the fund that is appreciating more and paying me more returns on my capital. When we look at portfolio growth, you can see that even during that little downturn, everything went down. But again, SPYI does a better job on that. One thing about JEPI is they're not a true S&P 500. They're more of some defensive stocks, less volatility, and that also goes to their price appreciation of why they lag in that price appreciation. SPYI actually owns all the stocks in the fund, so that helps them manage tax loss harvesting by owning every single stock in the S&P 500. When we look at downturns, during the downturns, JEPI's actually going to be better during the downturns. That's because they use more defensive stocks. But when we look at everything else, we're looking at what we're getting returned. I'm still going to stick with SPYI. Looking at QQI compared to JEPQ, again, a $50,000 investment. We are lagging behind the Qs, but we're very close. And at times, we're actually above. As QQQI is a newer fund, we don't have as much history on returns. But looking at the data that we do have, it's staying fairly close to QQQ, where JEPQ is falling behind. And again, no question about it, you're going to receive more income out of QQQI than JEPQ. JEPQ's been around longer, but when we look at the downturns, QQQI performed just as well as JEPQ. In the most recent downturn, it actually performed better than JEPQ. What I like about it is how they do laddered calls. They also have in their prospectus the opportunity to buy a call under certain conditions, so that when they would buy the call, they're looking for more capital appreciation. By doing these ladders, they're not actually capping us when the stock price goes up. They write these options 6 to 7 weeks out, and they roll them approximately 3 to 4 weeks before expiration. Gives us a good sign of what they're doing and how they're managing it. And it also makes me feel a lot more comfortable knowing that they targeted the 12 and the 14%. They wrote the calls as they needed to write the calls. And even if we get to one of the calls, they have another call even at a higher strike price, so we can continue to get some capital appreciation. And that's important. Not as important as the income, but it is important to continue to see capital appreciation. That way you don't have to worry about NAV erosion. I should stress they do have a higher cost. JEPI is at 0.35%. SPYI is at 0.68%. So they do have a higher cost to the ETF, but they're actually doing more of a management. One thing I don't like about JPI and JEPQ is they use ELNs. So you can't see the calls. You can't go look at what they did and how they did it. And it also involves third-party risk, because they sell these ELNs or they're purchased by banks, and those banks go belly up. Well, guess what? You just lost that money. They're not going to get those funds. So that is a third-party risk that you have to worry about with JEPQ. All good funds. I prefer to go with the higher yielding for my core, as in SPYI and QQQI compared to the others. If you like this content, please hit the like and subscribe button. Also, leave any comments below. I'll get to you. And I look forward to seeing you in the next video. God bless.